The first half of 2024 is behind us, and this is coming off of a year in which we saw the S&P 500 in 2023 climb more than 20%. Through the first half of this year, we're already up 15%. That is phenomenal growth, and that's why I often say I prefer time in the market rather than trying to time the market. There's a lot of naysayers out there and those that try to time the market that missed on some big time gains. But in today's video, we're going to turn our attention to the second half of 2024, where I'm going to be giving you 7 stocks that I believe have some upside moving into the second half. We'll be going through these rather quickly. It's going to be a little bit of a quick list for you today. But before we jump in, do me a huge favor. Click that like button down below. Show your appreciation, which also shows YouTube that you enjoy my videos. And if you're not already subscribed, hit that subscribe button so you're notified anytime we drop new content. And let's jump into it. Hey everyone, Mark Russin here, back for another video. As always, I'm a CPA and not a financial advisor, so please do not take this as financial advice. And before we begin, let me thank today's video sponsor, which is The Motley Fool. The Motley Fool has a ton of great resources and products available for investors of all different levels. And right now, if you go to fool.com/Mark, you could sign up to receive their 10 best stocks to buy right now. All right, let's jump back into today's video, taking a look at 7 stocks that I believe have some solid upside moving into the second half of 2024. And let's begin with one of my favorites, which is Visa, stock ticker V. And this is a company that I've covered a number of times on this channel. After all, they are the largest financial processing company that's out there. Credit cards, and they've had a bit of a pullback. Valuation looks rather intriguing at these levels. Looking here, you can see that Visa has a market cap of $526 billion. Over the past 12 months, shares are up 10%. However, year to date, we're pretty much flat. Again, this day and age, more and more people are moving away from cash and moving towards that little plastic thing, that credit card, which shows in the volume uptick that we've seen in the likes of Visa and even some of its close competitors like American Express and MasterCard. The thing that I really like about Visa, though, is they operate at a very efficient level. They have free cash flow margins in excess of 50%, a great management team, and an in-depth look at the strength or weakness with the US consumer or even the global consumer. The company isn't well known for paying a high dividend, but more for a fast-growing dividend. As you can see here, they have a dividend yield slightly below 1%, but they have a 5-year dividend growth rate of 16%, something I like a lot. And they've been growing that dividend for 15 consecutive years. Now, in terms of valuation, we could see that analysts are expecting the company to generate 2025 EPS of $11.19 per share, which equates to a forward PE multiple of 23.5 times, well below the company's 5-year average of 31.9 times, and even below their 10-year average of 29 times. In terms of analyst expectations, they have a 12-month price target of $317 per share, implying upside of 21%. Now let's move on to stock number 2, which is Amazon, stock ticker AMZN. And if you've been following along on my live shows, you know that I've been looking to build an even larger position in Amazon. I believe that they will be, in the next 5 years, more valuable than the likes of Nvidia, a company that in 2024 surpassed them. I think it's going to flip though, and Amazon will be larger than Nvidia in the next 5 years. Why? Because they have a lot of levers that they can pull. They have AI efficiencies that are gaining. They have an already massive position within cloud. We know about the retail component and many other areas of the business. The company currently has a market cap of $2.08 trillion, and over the past 12 months, shares are up 53%. Year to date, not too bad as well, as shares are up nearly 30% so far in 2024. This is a company that continues to generate more and more in free cash flow. And I expect over the next 12 months that they will have free cash flow margins in excess of 10%, something I often look for before investing in companies. But given the fact that they recently turned free cash flow positive, they do not yet pay a dividend, as they're still more focused on gaining more efficiencies, increasing their free cash flow in general before choosing to pay a dividend. In terms of valuation, analysts are looking for the company to generate 2025 EPS of $5.87 per share, which equates to a forward PE multiple of 33.2 times, well below their 5-year average of 65 times. But with fast-growing stocks, I don't pay as much attention to the 5-year average as I do for more mature type companies. So let's look at EV to EBITDA, where they trade at 22.3 times compared to a 5-year average of 26.3 times. So some good valuation that you see from different angles when it comes to Amazon. In terms of analyst price target, they have an average 12-month price target of $223 per share, implying 15% upside over the next 12 months. And that leads us to stock number 3, which is Alphabet, stock ticker GOOGL, yet another component of the Magnificent Seven. The two I like most, Amazon and Alphabet. And Alphabet happens to be my largest individual stock holding in my portfolio, and a company that I don't think is getting the credit they deserve when it comes to AI. Now, when it comes to marketing their AI capabilities, they have completely fumbled that, and I think they need to regain confidence from the consumer and investor moving forward, something that they've already taken steps to address. As you can see here, the company has a market cap of $2.36 trillion. Over the past 12 months, shares are up nearly 60%, and year to date, up 33%. Alphabet generates huge amounts of free cash flow. They have done this for a number of years, and at the same time, they are spending billions of dollars in CapEx, a lot of that going towards AI right now. But given that they generate so much in free cash flow, and they're not slowing down their capital expenditures all that much at all, they even upsize them, they still have enough cash to also pay a dividend, something they declared for the first time just a few quarters ago. The dividend yield currently sits at 0.4%. So again, no one is investing in this particular company for the dividend. Now let's turn our attention to valuation, where you can see analysts are expecting the company to generate 2025 EPS of $8.53 per share, which equates to a forward PE multiple of just 21.6 times. We're talking about a Mag 7 company growing at a solid pace, trading close to 20 times. The company has a 5-year average of 25.7 times, and in terms of the PEG ratio, which looks at the PE ratio as well as the growth, it's only at 1.5, which is right around the area that or lower in which I'm looking for some value. In terms of analyst expectations, they have a price target of $200 on the stock, implying 8% upside from current levels. And that leads us to stock number 4, which is Zscaler, stock ticker ZS. And if you've joined me for any of my webinars or my weekly live show, which we discuss a lot of common themes that I'm looking for moving forward, 2 of those primary themes are AI and cybersecurity. Zscaler operates in cybersecurity. And one of the cybersecurity stocks I could have easily had on this list could have been CrowdStrike, one of my favorites, one that I've held in and out of over the past 2 years. Right now, I don't have any position in CrowdStrike, but in terms of valuation and upside, I believe both of these companies have the upside, but I think from a valuation perspective, I really like Zscaler. Before we look at valuation, let's take a look at performance though. The company has a market cap of $30 billion, and over the past 12 months, shares are up 27%, and here in 2024 so far, they are up nearly 12%. The company saw its free cash flow turn positive back in 2018, and they've been building upon that each and every year to the highest levels we have seen to date over the trailing 12 months. And in terms of free cash flow margins, those are now at record highs approaching 30%. The company is still generating more free cash flow, and growth is a focus as well, so they do not yet pay a dividend. In terms of valuation, analysts are looking for the company to generate 2025 EPS of $3.27 per share, which equates to a forward PE multiple of 59.9 times. But again, these high growth stocks, I don't pay all that much attention to PE ratios and comparing them to their 5-year average. Instead, I would like to focus more on PEG ratios or enterprise value and EBITDA, which is what we have here. There's a lot of upside in terms of EBITDA for this particular company. And speaking of EBITDA, they just turned profitable in the past 12 months or so. And anytime a company is just turning profitable in terms of free cash flow, in terms of EBITDA, that's usually a good sign to jump in. There's some momentum with that stock. In terms of analysts, they also see some sizable upside with a price target of $236 per share, implying upside of over 20%. And that leads us to stock number 5, which is Berkshire Hathaway, stock ticker BRK.B. We're not going to look at the A one here. We're going to be looking at B. And when you invest in Berkshire, Warren Buffett's conglomerate, Warren Buffett's company, it's like investing in an ETF. The company is very massive. They have their sizable private portfolio as well as their equity portfolio, all rolling into Berkshire. Many of their notable names that folks watch within their equity portfolio are going to be companies like Apple, American Express, Coca-Cola, or Occidental Petroleum, a company that he's been investing a lot into of late. All of these companies roll up into the equity portfolio, making it in many ways like an ETF. The company currently has a market cap of nearly $900 billion, making it a great candidate for the next trillion-dollar company. Over the past 12 months, shares are up 23%, and so far in 2024, shares are up 17%. Warren Buffett and his good buddy Charlie Munger have built Berkshire into a juggernaut. And unfortunately, earlier this year, we lost our good buddy Charlie Munger, and Warren Buffett isn't too young himself, as he is in his mid-90s. But the company has been going through a succession plan for a number of years now, and I believe they are in great hands moving forward. So investors today need to start thinking about that post-Buffett Berkshire. And it is also well documented that Berkshire does not pay a dividend. They actually have paid one in the history of the company. And Warren Buffett always likes to joke, saying he was probably in the bathroom when the company declared a dividend. He prefers to pool all of his cash together and go out and buy businesses, whole businesses, or invest in particular stocks. In terms of valuation, you look at Berkshire a little different, but we'll look at the same as we've done all the other companies first. They have a 2025 EPS estimate of $19.52, implying a forward PE of 21.1 times, slightly below their 5-year average of 23.3 times. But another way to look at Berkshire is by looking at what's called price to book, looking at the stock price compared to the book of their net assets, which is around where they've been trading over the past 5 years. In terms of analyst expectations, they have a price target on Berkshire of $471 per share, implying upside of roughly 13%. And that leads us to stock number 6, which is Vici Properties, stock ticker VICI. Now we're moving to the REIT sector, and Vici Properties is one of my favorites, one I talk about a lot, one of my top REIT holdings individually as well. REITs in general are very interest rate sensitive. And what have we dealt with over the past 2 years? Very high interest rates. But what are we nearing in the very near future, within maybe the next couple of months? Interest rate cuts. And that is when REITs are going to be off to the races. Vici Properties currently has a market cap of $29 billion. And over the past 12 months, they are down 7%. Much of the same here in 2024 when they are down 8% year to date. REITs over the past few years have been the worst performing sector. And in 2024, they are the only sector that is actually in the red. And for those of you unfamiliar with Vici, this is my top REIT pick for the foreseeable future. They have some fantastic asset classes, not just in Las Vegas, where they are the largest landlord on the Las Vegas Strip, but across the US. In addition to the growth potential, Vici also pays a sizable dividend, with a dividend yield of roughly 6% and dividend growth of 8% over the past 5 years, and they have been growing that dividend every year they've been a public company. In terms of valuation, again, when it comes to REITs, we don't look at EPS. We prefer to look at what's called AFFO. And analysts are looking for the company to generate 2025 AFFO of $2.33 per share, implying a forward price to AFFO of 12 times, which is well below the company's 5-year average of 16.3 times. Analysts are also upbeat on the stock with an average 12-month price target of $34 per share, implying 15% upside from current levels. And that leads us to the final stock on our list, stock number 7, which is Prologis, stock ticker PLD. Again, finishing off with yet another REIT, going through 2 of my favorite REITs, 2 of my top picks for the foreseeable future, Vici and now Prologis. Right now, e-commerce sales make up roughly 20% of all retail sales. But if you go over to Europe or the UK, retail sales, 30% of those are e-commerce sales. So there's a lot of upside when it comes to e-commerce. Why is that important to a company like PLD? Well, they happen to be a logistics and warehouse REIT. The company currently has a market cap of $109 billion. Over the past 12 months, shares are down 1%, but year to date, they are down 10%. So investing in a company like Prologis is yet another way to invest in the future growth of e-commerce. E-commerce is going to continue to penetrate retail sales. And they're not just a company here in the US. Prologis is a global company. And when you look at their largest tenant, it is Amazon.com. So yet another way to play the growth in e-commerce. In terms of the dividend, PLD is unique in the fact that they are a rare dividend growth REIT, something you don't see all that often based on the structure of REITs in general. They have a dividend yield of 3.3% with a 5-year dividend growth rate of 13%, and they've been growing that dividend for 10 consecutive years and counting. In terms of valuation, analysts are looking for the REIT to generate $5.10 per share of AFFO, which equates to a forward price to AFFO of 22.9 times, well below the company's historical 5-year average of 29.2 times. Analysts have an average 12-month price target of about $130 per share, implying upside of nearly 10% in the stock. So there we just looked at 7 stocks across many different sectors. You had high growth stocks, you had REITs, you had more mature dividend type stocks where we're looking more from a valuation. When we look at these 7 stocks, we're not necessarily looking for the fastest growing. We're also looking for quality, good entry points for us long-term investors. In the comments section below, let me know a few of your favorites on this list. And if you haven't done so yet, make sure you smash that like button down below, subscribe to the channel, and we'll see you in the next one. Take care.